If we want to fix the economy, we must look at the markets. Today, the financial markets do not operate normally in a historical sense as well as a fundamental one. It is very important to see where the problems are, analyze them, and hopefully turn them around. Financial markets need to be able to perform their function without manipulation. If there is intervention, it will create major distortions and signals will be misread. Today, we have so many companies that are considered zombies. They cannot operate on their own. They cannot sustain their actual business model, and yet they continue to see money flowing in, investors pouring their money, their savings into these companies because of speculation. That is a very dangerous thing that we are noticing, a trend increasing as we saw during the dot-com boom and bust. The problem with this is that the more efficient, more logical, and more prudent companies do not see the money, do not see the investment, and it is simply being chased where it will attain the highest percentage return. The chase for yield ultimately creates malinvestment and problems down the road. Today, markets are heavily manipulated by central banks, admittedly, supposedly to the benefit of the public. We are noticing this with the open market operations, with the plunge protection team, with all of the different aspects that have been introduced in 2020 and beyond. This cannot be sustained and shouldn't be looked at as positive. Their actions are to manipulate interest rates down further to stimulate a bubble, as well as buying bonds, debt, ETFs, stocks, etc., to become a crutch to these financial investments. Understand what's happening here, that the Federal Reserve, the Bank of Canada, the PBOC, the BOE, all of the different central banks around the world are basically doing the same thing. They print money out of thin air, they lower interest rates as far down as they can get them historically right now, near or at record lows, and then they buy up different types of assets, whether that's bonds, whether that's ETFs, and so on. This is never a good thing because it is creating a moral hazard. They're buying into certain things that might be worthless, that might not have any value, that should be going bankrupt, that should be going under, and yet they are supporting it. And because they're supporting it, investors see that and they follow that trend. That is not good. That is terrible for the actual economy. Instead of somebody using their money to buy some real estate, to fix some infrastructure, to actually put it towards good use, they are simply chasing yield. As a result, there is no price discovery, no indicator that makes much sense, so people speculate. The longer this goes on for, the more desensitized people are to the obvious problems. We are seeing the same patterns from the tech bubble and burst. People are falling for it simply because there's nowhere else to achieve that yield. They don't want to go and put their money in the bank. They're not going to get a return for it, and they know what's happening with inflation. So I understand why this is happening, but look at the overall, look at the top down, the bird's eye view, and you can clearly see the problems that this creates down the road. Financial markets must be allowed to rise or fall. Everything must be allowed to fall if necessary, because this is how fair value is achieved. Investors traditionally buy when assets are at fair value or below fair value and sell when it's the opposite. That doesn't happen today. You're not seeing people actually buying things at fair value. They simply buy whatever they can at any price. This is because of the central bank activity and what they have done. This creates issues in the economy itself, and this is fully described here. I think it is very clear, but people do not care about that, and it is quite unfortunate. But the disconnect here will be felt eventually, and it's going to be painful the longer this goes on for. Hang on, don't go anywhere. You've got to check out the next step in this series.